Hey! Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader and analyst at Cointelegraph. Today's show starts by discussing whether or not the United States is entering a recession. The US economy keeps skirting recession, but consumer sector might be slowly splitting apart. The signals that economics lean on to gauge the odds of a recession are contradictory at the moment. Okay, for example, we all know that the US gross domestic product, or GDP, has been growing at a mild pace, less than 1.5%. Of course, analysts expect a slowdown for the next couple of quarters, erasing the previous gains by the end of 2023. So a full-blown recession by the end of the year. On the other hand, the inflationary pressure remains the biggest concern after the CPI, the Consumer Price Index, stagnated near 5% for 2 consecutive months. This forces the US Federal Reserve to keep interest rates high, near 5%, which in turn have negative impacts on the credit and consumer demand. This is why investors are so worried about layoffs and reduced profit for the listed companies. We also have mixed data from the housing market, as the article explains. New home sales have actually been trending upward again in recent months, despite elevated mortgage rates. There has been a dramatic decline in the number of existing homes being placed on the market, which is exacerbating the national housing shortage and could make demand look stronger than it truly is. So what the article is basically saying is that as home prices went down, sellers took their offers out of the market. So there's a shortage of offers, which apparently shows strong markets, higher demand than offer. But that's because prices begin to drop and sellers took their offers out of the market. Okay, but what about cryptocurrencies? Why is the total market capitalization at 1.1 trillion down 12% in 1 year, in 12 months, while gold is up 6% and the S&P 500 gained 4%? Well, you've got to understand that most investors still value cryptocurrencies as a risk-on asset, meaning they expect increased volatility compared to traditional markets. So, if they're expecting a full-blown recession later for 2023, why bet on something that will likely react very negatively? One might say that Bitcoin, for example, has been created exactly for those kind of moments, when investors seek alternative store of value methods. But the truth is, right now, the most sought after asset is short-term government debt and tech companies that will likely benefit during a crisis due to its dominant position and war chest. Some of those companies have over $50 billion worth of cash positions, cash balance at hands. So during a crisis, they can either buy competitors or go out and get new markets, issue new products. They don't care if there's a crisis for 2 consecutive quarters or even for a whole year. They've been prepared for that. There will come a time when the inflationary pressure will start eating up corporate margin and fixed income profits. But we might still have a long way before reaching that point. For now, investors just want to play safe and wait for the next steps from the US Federal Reserve. So there's no apparent driver for a crypto bull run in the short term. On our second article today, we'll cover lithium batteries. Lithium batteries are the new oil according to Elon Musk. Lithium is an essential component of modern rechargeable battery technology. China is the dominant player in the production with a market share of approximately 80%. Well, despite the multiple recommendations from analysts and pundits, it turns out the lithium market is way smaller than most expect. More precisely, an $8 billion market per year. But heavy government subsidies and rules to minimize carbon emissions have skyrocketed the demand. The refined lithium supply is, for now, limited. As you might have guessed, even without looking at the chart, lithium futures price jumped from $14 in June 2021 to $83 in May 2022. However, the six-fold increase turned out unsustainable as additional product reached the market, so the supply increased, the offer increased, and its price have since come down by 54% since the peak in May 2022. I know, lithium and electric vehicles are a promising segment, but in the grand scheme of things, it is extremely irrelevant for investment purposes. The global portable, the mobile video game market amounts to $120 billion per year, so 25 times larger than the lithium market. And we're not even covering the consoles or the PC gaming. But there's something even more sinister about the lithium market. 3 months ago, Iran, the country, said it has discovered the world's second largest reserves, with 8.5 million tons of lithium. As a comparison, the known reserves of US and Canada combined amount to 2 million tons. Goldman Sachs Investment Bank expects lithium's production to increase by 34% on average per year. That's a huge inflationary problem for those betting on the commodity price increase. So the question here, at least for the crypto market's perspective, is could the same happen to gold? What would happen to the supply side of gold if the price moves from the $2,000 to $4,000? Well, I guess you already know the answer. We would likely have a new gold rush, with entire cities and abandoned mines being reopened. It doesn't matter if the costs have risen by 50% if the metal price has doubled. I know it is tempting to follow the lead of the world's wealthiest man or bet on electric automobile industry growing over 35% per year at a steady pace to compensate the lithium production increase. But those incentives that have created the distorted demand in the first place will unlikely hold for so long. The governments will run out of money. And even if lithium's price continue to increase, so will the supply. But what does that mean for cryptos? Well, you should focus on scarcity. And I'm not talking exclusively about Bitcoin here. Let's assume you're a huge fan of decentralized exchange DEX or NFT marketplaces, and they have some kind of utility token issued or governance token for each of the DEX or each of the NFT marketplace. So you should start by checking how many coins, how many tokens have been given to founders and supporters, what is the token unlocking rates, the vesting periods, the quantity handed out via airdrops. We'll never know the demand for sure, but at least you should have the total picture, a total understanding of the supply side of those tokens before you make an investment decision. I don't even think that supply or the offer side is the most important thing. For example, in Bitcoin, we know there's 900 coins issued per day as incentives to miners, but some of those miners are sitting on the coins. They're not selling out on the open market on a regular basis. So even if you know the supply, which in Bitcoin's case, it's very, very easy to predict because there's an adjustment every 14 days, more or less. So you have 900 coins issued per day. We don't know how many are hitting the market. So it's even more complicated for those DEX and NFT marketplaces for you to guess if these coins are going to be sold or not. But assume the worst case scenario. If the vesting period is 1 year, that holder, whether it's a founder or investor, will be selling this coin, so creating additional selling pressure. Our final take on lithium: let Elon Musk does his thing, whatever it is, and concentrate on finding scarce assets that will hold up during a crisis. Well, that's it for today. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. Over and out.